Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Usually, we do individual stock analyses on this chart, but I'm going to talk a little bit about the Federal Reserve and interest rates and kind of where I see some of that going. I think probably the Fed is going to cut 50 basis points tomorrow, and so I want to talk about why I think that's so and why it probably makes sense. I've seen just a lot of anecdotal evidence that things are trending toward like recession, but we aren't there yet. And so now would be a good time, just in general. And to give you some examples, um, auto costs are coming down in prices, big ticket items, RVs, boats, things like that are interest rate sensitive. Now, the housing market's been its own kind of animal and it's a little bit weird. But it's kind of been frozen, which is another example, I guess, in its own way, even though prices haven't really come down in a lot of areas. That kind of has its own dynamics. Let's see. The unemployment rate has been rising. Salaries rate has been coming down. All the other inflation metrics are coming down, which is what I'm going to look at. But I want to talk a little bit bigger picture about what I think there's like a narrow kind of area that everything needs to stay in order for a recession not to happen. So we talk a lot about the federal debt here in the US, and it's quite big. And my opinion is the only way to really handle that is to keep inflation around in between like 3 and 4% on average over the next, like 5 or 10 years at least. So that's kind of where I think everything needs to go. And I also think that probably means if inflation is going to be in between 3 and 4%, that means interest rates need to be in 3 to 4% so that people who are saving money aren't losing money. Like if you just have your money in treasuries or CDs or something like that, I don't really necessarily think people should be able to make real earnings by buying treasuries or putting their money in a savings account or whatever. But it should be able to keep up with inflation. Otherwise, it causes other problems. So I think those need to kind of roughly be in line. Now, they don't have to be identical, but so if inflation is, we want it to be really, in my opinion, in between 3 and 4%, or at least close to, on the low end, 3%, then we need interest rates to probably be about the same, roughly. And that's what I expect to happen. Because if inflation really slows down over an extended period of time or even goes into like deflation, then we have bigger problems. Well, one, we'll probably have a recession, and then that causes all kinds of other problems. So with defaults and things like that, and then we'd have to have, if we want to try to prevent the recession and the things that come with it, just like 2008, we probably have a bunch more, or the pandemic, where we have a bunch more federal spending. That just ultimately makes things worse, right? So ideally, you want to inflate some of this debt away while still not hurting people who are just saving, and businesses and everything else who just have money basically in the bank or loaning on short term, like 1 month treasuries or 3 month treasuries or something. So you don't want people to be losing money by saving it. So I think those two need to be in line, and then you can kind of slowly inflate and grow as the economy grows and through productivity, and you kind of take a little off of each of those, and you can get the debt under control over the longer term. Now, the investors that ultimately pay for this are long-term bond investors, and everybody's been bullish on long-term bonds forever. It seems like even when they get killed, then the pundits are like, "Oh, now's the time to buy bonds," because and they did in the 10-year. I think did hit 5% briefly, and that was probably a decent time to buy. But those are like traders, right? Well, if you think this is for people that, basically want like guaranteed 5%, but in a 3 to 4% interest rate environment, 5% a year is only 1 or 2% of real, growth. So, which is, if that's what a person, I want better returns than that. So I don't really think about that, and if I want safety, then I just buy, short term cash or treasuries or whatever. But I ultimately, I'm a little different in that I want to own the stocks of businesses that are growing earnings. I just want to buy them at a good price. So sometimes there aren't enough available. And so I just wait in cash basically. But a bond trader can go in and buy at 5%. And if the price goes up, the yield goes down, right? So the yields are down to like 3.6. So if somebody's trading that, then they've made money. So it's not, some of it has to do with like the time frame a person's talking about. A person buying, the 10-year treasury when it has a high 4.7% yield or something have done well since then, but not before they did like really poorly. And this video isn't really about like bond investing, but I do want to say that it's the pain, the price that's going to be paid, I think, are going to be, long-term bond holders, not active traders necessarily. You buy it and you hold it to maturity, right? So if you're getting a 3.6% yield over the next 10 years on U.S. Treasuries, the 10-year Treasury, and inflation is in between 3 and 4%, you're not getting killed necessarily, but you're not making any money, and you might even lose a little bit of money in real terms. So I'm talking in real terms. And I think that is who is going to pay for the national debt. And I've been saying this for a couple years now. So because everybody else, everything can still function pretty well if that's where it comes out of. And if you look back to the late 40s, that's who ultimately paid for, World War II. So I think that's the playbook, and that's how things are probably going to try to go. But it's always really fragile when you're trying to balance things like this. When the trajectory, if you look at the inflation rates all falling here, if I'm looking at the chart in front of me, which came from Y Charts, by the way, I want to give them credit since I snapshotted this. But you can find this on the Federal Reserve site too. It's just not as easily displayed, or at least I haven't figured out how to do it yet. So inflation's falling, wages are falling, both measures of inflation are falling, but the Federal Reserve rate has stayed the same. So if you go back to 2020 before the pandemic, I don't know what this is about, maybe like 1.5% or something, or maybe close to 2%. And then the funds rate is lower than both core inflation and normal inflation, and also lower than salaries, which were growing. That particular, we had tax cuts and stuff, so they kind of grew pretty fast leading into 2020. And then the pandemic kind of screwed things up. But you can kind of see that, the interest rate was actually below inflation by a little bit, but it wasn't a lot. And now we have a totally different situation, and the gap between the Fed funds rate and wages, wage growth, inflation and core inflation are all like going down. So, and they've built up quite a bit of distance between them and the funds rate. And so for me, these all pretty much need to be in line. And I think if, the Fed's kind of doing its job, they should all be in that kind of 3 to 4% range. I mean, if you wanted to tighten it down to like 3 to 3.5, okay, fine. If we can get that exact measure. But the point is, this 5.5 rate needs to get down to like 3.5 probably. So that's a pretty big distance. And while we're waiting, if it just stayed here, this trend that we see with everything else here is going to keep going down, and we'll probably go into recession if nothing changes pretty soon. We still might go into recession. We have yet to see whether that will happen. But I do think that there's not really any sign now that unless rates come down, inflation and everything else isn't going to stop dropping. And we also see credit card delinquencies up pretty high. Just student loans the delinquencies on those aren't even being tracked. So, well, they're probably being tracked, but I mean, they're not showing up on like credit reports until the beginning of next year. And so I actually think that's not true. It starts in October, I think. But to get like 90 days delinquent or whatever, then you have to go like 3 more months. So probably start seeing some data, after the election or whatever come up. But they're going to be bad. They're going to be bad because there wasn't really much student loan relief, and there's a lot of people that can't afford to pay those, and we know that it's bad, but I don't think we know how bad it will be. And that's only going to get worse as people can't pay their car loans. And then this is how recessions start, right? And then once people are like, oh, I know people have been saying like recession for a long time, and I've been prepared in like the portfolio for a recession. But being prepared, when it comes to investing, you have to be in front of everything because the market's forward looking. So you can't wait till there's an actual recession to adjust your portfolio to be ready for a recession. You need to be ready like 18 months, 2 years in advance, if you want to avoid kind of the worst of it. So all that said, I think the Fed lowers rates. If things keep going the way they're going, probably you're looking at, at least a full percentage point decline in rates this year. And I mean, I wouldn't be surprised if we get down to like going into next year, like that 3.5 area, unless something ticks up, unless inflation kind of ticks back up, which is a possibility, because it hasn't. If you look at core inflation, it's only at 3.2%, and supposedly the Fed wants it at 2, but I don't believe any of that. So I think they want it at 3, and we're almost there. So they'll talk about 2%, blah 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 blah, but the gap is so big, and there's delay. If you just take normal basic theory, that I've talked to some people who have a very different view on how this all works, and I think there's something to be said for that when you can just collect 5.5% on your cash, which is what I've been doing, or 5.3% for the past year or two. That affects the economy in ways that aren't captured necessarily by standard economics or whatever. I think there is something to be said for that, but if you look at real big ticket purchases that people normally borrow money for, those industries have gotten hurt pretty bad, or they're in the middle of it right now. And so if there isn't some relief, then you get those defaults, and that's what the bankers care about. And when people start defaulting, then the banks have a problem, and that can cascade pretty quickly. So I think they want to get in front of that and try to mitigate it. So if you have a bunch of cars, all right? I've watched a couple of YouTube videos where they're at like Coparts auctions and stuff, and they basically have like repos and things like that. The lots are filling up kind of each month, and the banks that own these cars that were repoed, they're really trying to stick to prices that are unreasonable, or they're not letting the cars be sold at the auction. So they'll have like a reserve price on the car. So then it just runs at the auction, the next auction in the next week or whatever. And so there's a lot of these that are just kind of sitting around, that banks want to get more money out of, but there's nobody there to buy them at the prices they want, because to get a car loan on one of these cars is, for most people, is going to be like 8% right now. And so there's kind of a battle in the market going on, and the banks are trying to wait out. And if rates go down, that allows more people to pay more for a big purchase like an automobile, and that allows the banks to recoup more of their money on these defaulted loans and repossessed cars. And so they need interest rates to come down so they can balance out the money that they're losing on these defaults. And that can be applied to like a lot of different other things other than just automobiles. But that's one I think that's kind of easy to see and understand. And so I think that they need to get that ball rolling probably, and they know it. And we're probably going to see a half point rate cut and start to see these things coming down. I don't know if it will be enough. Once these things kind of start cascading. Also, the election could have an effect on people's mentality one way or the other. People could become more bearish on the economy, on America, on no matter who wins. And so the way people feel affects the economy. If you feel confident about the economy, maybe you're willing to go out and borrow money, feel more confident about your job and things like that. So there's a lot of kind of animal spirits that are going to be taking place in the next like 3 months. And, the Fed would I think they're probably smart to start lowering rates now, and just to kind of help smooth out whatever kind of craziness ensues over the next 3 or 4 or 5 months. So that's kind of my thoughts overall, investing wise. I mean, this is kind of how I've been set up for a while. I still have about a third cash. I buy things whenever I see them, and I've been rotating out of more economically sensitive stocks, buying more cyclicals only when they're down like a lot. Like most of them are down like 65% when I'm buying them. So that if we do get lower rates, those should come back and we do have a soft landing. Those should come back strong. But if we don't, I can hopefully just wait, and 3 or 4 or 5 years, then they'll come back. So I try to buy in cheap enough where that will be the case. So I haven't really adjusted. And then the growth stocks I'm buying are just buy and hold, and hopefully they can grow through any weakness better than a more established business that will be hurt more in a recession. So that's basically been the playbook for like the past 2 years, and haven't really changed anything yet. So we'll see what happens when if interest rates come down, and we'll see what kind of a landing we ultimately get like 6 months from now. But I'm pretty sure that the Fed's going to be cutting. And then it's possible wages like if the economy picks up, okay, now we're right in that 3-4% range. All the folks that maybe were buying bonds, which everybody's pushing right now, well, they're not going to be super attractive if the core inflation rate even picks up a little bit to 4%, because all those bonds are yielding under 4%. Like all I'm just talking like treasuries, not corporates or anything. So if we do have a soft landing or a softish landing or what, they don't really look great. So I don't own any of those. That's maybe my main message. I just have like short-term floating rate treasuries and for cash, and then I try to buy the stocks of businesses that if we do have inflation will do well, and they'll be able to grow their earnings and work out that way. So it's not super exciting. It's pretty well balanced. And then if we do have a deep recession, I can hopefully use that cash. That's when I want to put the cash in. If that helps frame things for folks anywhere, everybody, give them something to think about. I think it's a little different than a lot of people talk about it, because I'm willing to admit I think that we're not going to have 2% inflation without I don't think we're going to have sustained 2% core inflation without a recession. I think the odds of that are very small. So that's why I don't think kind of government, like medium and long-term government bonds, look very attractive. And I think that it's almost more important to know where you're going to slowly lose money than it is to know where you're going to make money. Okay, if you found this useful, hit the like and subscribe button. I do a lot of individual stock analysis, which is like 90% of what I do, but every now and then I'll chime in on something like this, and I thought this was interesting enough to kind of let everybody know what I was thinking, and I'll see everybody later.